Hello and welcome to the first Rapaport Research Report quarterly webinar hosted by Avi Kravitz. Avi is a senior analyst and news editor at Rapaport with over 10 years of experience covering the diamond and jewelry industry. He is a leading analyst in the industry who has authored reports spanning the entire industry pipeline, including rough production, polished diamond trading, and jewelry retail sales. If you have any questions during the webinar, please write them in the chat and Avi will answer them at the end. And without further ado, Avi Kravitz.
Thank you, David, and welcome everyone. It's a pleasure to be here, and thank you for joining us. Which is our first quarterly webinar. We hope to be having these on a quarterly basis. We publish the research report on a monthly basis, but we felt it was an opportunity to give our take on the market at the end of each quarter, and that's what the purpose of this webinar is. I intend to speak for about half an hour, 35 minutes, and then I'll be happy to take some questions from whoever submits those questions in the chat, as David mentioned. Just to go through quickly what our goals for this webinar are, I want to talk through some of the trends that are influencing the 2018 market improvement, because we have seen an improvement in the market in the first half of this year, and there are various economic factors that have played into that improvement. And then we're going to demonstrate how we're seeing that improvement in the data that's presented in the research report. So just a bit about the research report. We launched it in January of this year, and we're going to be publishing the 7th edition on this week. In fact, late tomorrow afternoon, we'll be publishing the July issue. And the report is basically broken down into 3 sections. Those sections are giving an in-depth editorial research on various themes affecting the market. We've covered credit to the industry, the US, the state of the US jewelry market, diamond production, etc. The second section is our market analysis, looking at the rough, polished, and retail sectors on a monthly basis. And then, of course, there's the proprietary data that we have from RapNet. And the research report is really a collaboration of three divisions of Rapaport. It's the Information Services Division, which publishes the price list and the magazine and diamonds.net, as well as the research report. We are working together with RapNet on the data that's presented in the report, and also our trading division. And with me in the room today is Shimon Gerstenstang, who has been very helpful in understanding some of the trends that we're seeing in the data. So in terms of the data in the report, the report covers the market from a supply and a demand point of view, looking at the 30 pointers, half caraters, 1 carat and 3 carat. We're dealing with round wrap spec A3 and better diamonds, and it presents pricing, sales, and inventory information for select categories and countries. What the data does not include is the RAPI, which is our benchmark index, which gives a broader overview of trends in the market based on the average asking price of the 10% best priced diamonds on RapNet for the top 25 quality diamonds in each category. The RAPI data in the research report is provided in the market analysis, particularly the polished section of the report, but not in the data section. And as many of you might know already, having subscribed to the report, that's the data section. That's how we present our data section, and we'll get more into that a bit later in the report. So as I mentioned earlier, we're seeing a positive feeling or positive sentiment in the market in 2018. And this is reflected in the RAPI index. This graph that you'll see on your screens shows the RAPI index for those 4 categories I mentioned earlier, and each is showing a fairly significant increase over the first seven and a half months to date. And we'll get into the specific numbers a bit later. But it's worth putting that improvement in context, because really the market's been on a general downtrend ever since, since 2011, which was a bit of an anomaly year. And in fact, I feel that we've still been on the general correction in the market since 2008, the 2008 financial crisis. But there's a difference between the increases that we see in 2011 and the slighter, more modest increases that we're seeing this year. In 2011, initially the market was boosted by the expansion of jewelry stores into China. They needed goods to fill those stores, but it soon became a very speculative market that was unsustainable, and with polished prices having increased over 50% in a very short period of time, and we've been correcting ever since then. But I feel that this year is a bit different. It's certainly not comparable to 2011. If we look at on a quarterly basis, our RAPI index for 1 carat diamonds increased 0.6% in the second quarter, which was the first time that we've seen an increase in the RAPI index in the second quarter since 2011. In the first quarter, we had an increase of 2.8%, and again, that was the strongest increase in the first quarter, which is generally a positive period for the market since 2011. And I think it's sustainable for a number of reasons. And I'm going to spend a few minutes just going through what I see as those core reasons why the modest increase in 2018 is sustainable for the short to medium term at least. So the three factors are our economic environment that we're engulfed in. The second is the adjustment that the industry is making to the market conditions, and then there's the trading conditions that have evolved in 2018, and we'll deal with each one in a little more detail. So as far as the macroeconomic environment, we're seeing firstly, we're seeing growth in the two biggest markets for the first time in a long time, that both the US and China are growing at the same time. And in the US, these are some of the headlines that we wrote on diamonds.net, that we saw a very, very positive feeling coming out of the market over the holiday season. And that actually continued into the first quarter with the likes of Tiffany, Macy's, JCPenney, the higher end companies, LVMH, Cartier, all reporting strong holiday seasons and strong growth again in 2018. Signet, which didn't have a good holiday season, had a decent start to this year. And some of the factors that have fed into that economic environment is that the tax laws have given people a feeling that they're going to get more, they're going to have more income, money in their wallets to spend on discretionary items. Unemployment is down, and the stock markets hit record levels on a consistent basis in 2017. And while they've been a bit more volatile this year, the Dow continues to sort of edge up on a week-to-week basis, and that's giving people the feeling that they have more wealth, and so consumer confidence that has played into consumer confidence, confidence to spend on discretionary items such as jewelry, and we're seeing that in the numbers this year. Similarly, in China, we're seeing a return to growth at the major jewelers or Hong Kong-based jewelers. Chow Tai Fook, Chow Sang Sang, and the like all had declines in the last 3 years, but in fiscal 2018 and this year, we're seeing growth, a return to growth. And we're feeling that in the market. In the B2B market, we're seeing orders from the big jewelers, both out of Hong Kong and also in the US, and that's having an impact on the market, and feeding into that positive feeling that's out there. The second factor that I mentioned is the adjustment that the industry is making to changes in the market. And over the last 10 years, that prolonged downtrend that we saw in the RAPI was really a combination of economics, where the financial crisis demanded better compliance from diamond tiers, demanded a change in inventory, or more efficient management of inventory. There was a change in demographics in 2008 as millennials emerged as the core engagement ring customer. There was a technology boom, marketing changed as De Beers moved from generic marketing to their own branded marketing. And there were calls for better provenance guarantees than the Kimberley process was providing. And all these factors left the diamond and jewelry industry asking questions and kind of that they weren't able to answer, and that contributed to the downtrend and the negative sentiment that we've seen in the market until recently. In the last year, we're seeing the industry respond to each of those factors. From a marketing point of view, we've got De Beers focusing on female self-purchases, which broadens the range of marketing that it's the target audience that it's been marketing to until now. We're seeing Tiffany, for example, and other companies as well, going out of the box in the type of product that they're providing, the marketing, the language that they're using to relate better to millennials. And of course, the Diamond Producers Association has reintroduced a generic component to industry marketing. Also, we're seeing that jewelers are understanding that jewelry can be bought online, that e-commerce and omni-channel is becoming more of a factor for jewelers, and that's helping to increase sales of diamond jewelry and feed and having a trickle-down effect to the rest of the market. It's not just a matter of e-commerce; it's also using technology in store to sell, meaning that jewelers don't need as much inventory in the store, and relying on diamond tiers to tap into their inventory that they can present to their customers, and that's again influencing the dynamics of that of the requirements of inventory in the market. On the provenance programs, just quickly, we're seeing an increase in discussion, at least, on how to tackle this challenge, with various tracking programs coming to the market. And again, that's feeding into the positive sentiment that the market is doing something to meet the challenges that it faces. One thing on inventory needs, retailers are requesting more memo in the market, and this is just an example of Signet that has increased their memo or the amount of goods they're taking on consignment, and at the same time they're reducing the inventory that they're holding in their safes and in their stores, and that's again leaving the burden of inventory on the midstream and affecting the pricing, the trading environment. And finally, the third factor that's contributing to the sustainable growth that we're seeing in the market in 2018 is that trading conditions have vastly improved, and there are a number of factors in this section as well. That for one, we're seeing steady orders coming from the retail sector. After the positive holiday season, we saw that the momentum, usually the first quarter is a strong restocking period, but the momentum seemed to continue into the second quarter. And certainly we saw recently at the Las Vegas trade shows that the momentum is continuing and there's a positive feeling coming from the retail sector to the trading environment. Secondly, the rough market has been very strong in 2018. And rough prices have increased. We estimate that on average, they've increased by about 4% in the first half. And that's forcing manufacturers to protect their margins with polished prices. And so rough prices are supporting higher polished prices. And what we're seeing in the manufacturing sector is that the suppliers, predominantly from India, are giving a clear message that this is the price that they want, and and buyers need to accept that as the price, and they're really prepared to walk away from the deal if their asking price is not met. And so a new polished pricing level has been set, certainly from the beginning of the year, and that's continued through the first half and through to July as well. Just before we get to the data, and having considered all those positive aspects of the market, we do need to consider that there are still very clear challenges that we are keeping an eye on. For one, firstly, in July and August, it is a slower period for the market, and we don't expect a boom in trading activity, certainly in the next 2 months. We are keeping an eye on the effects of the trade tensions between China and the US, and the effects that could have on currencies. Certainly, we've already seen that the renminbi has depreciated against the dollar, and that could affect demand out of China, making local or diamonds and diamond jewelry in local currency there more expensive. And we're also looking at the size of the midstream, and we feel that the midstream is still overcrowded with companies, and that we can expect some consolidation, particularly as margins are quite tight. And when you speak to a manufacturer, that's their biggest concern, is the squeeze between rough and polished prices. And of course, bank financing is the banks continue to be very cautious in their attitude, in their lending to the diamond trade. And then finally, synthetics. The industry is still finding its feet in terms of the market share or the role that synthetics will play in the market, and particularly after De Beers announced that they're moving into the space. And we would expect that in the long term, it will have an effect on the melee market, at least on demand for very small goods used in jewelry. So when you look at the data that's presented in the Rapaport research report, we want to see that the data supports the premise that we've just presented, that the market is good, and that are we seeing this in the data that's in the trading environment. And what I'd like to present to you in the next few minutes is that we are in fact seeing that those positive trends, or understanding why prices have increased in the first half of the year. And we're looking at 4 components that the research report presents on a monthly basis. That is price, of course. Sales, the amount of sales in the market, the amount of goods that are in the market in terms of inventory, and the time to sale. And we'll see that each of these are pointing to a more positive market, or a more sustainable increase in polished prices that we've seen so far in 2018. I'm going to present to you those 4 factors on a general level, looking at overall stock of goods on RapNet. And also at a specific item of diamonds, we chose a half-carat D2H SI goods that we've seen a significant improvement in demand and in prices this year, and also because it's a popular item both in China and the US, that it's got a fairly broad appeal, this category of diamonds. And I hope that you'll gain some insight in how to read the data that's presented in the report on a monthly basis. And of course, again, if you have any questions, please feel free to ask them in the chat. So again, we see so on a general level in terms of overall stock on RapNet until the middle of July, RapNet, sorry, the Rapaport Diamond Index, the RAPI index, increased on all categories. For 1 carats, it was up about 3.4%. For 30 pointers, it was up just over 9%. For half carats, it was up about 6%, and 3 carats was over just over 1% for the period. So that's on a pricing level. When we look at the sales data, we're seeing again an increase in sales compared to a year ago. That the sales on RapNet that we have data until May for. Just a word on those sales. When we're working out the sales that go through, RapNet's a trading platform, and so we're not involved in the actual sale, but we're able to monitor goods that come on RapNet and understand the level of sales that take place through the platform. An interesting point to note here on this graph is February, that we saw a decline in sales in February, and what happened in that period, the manufacturers after the holiday season in January increased their prices almost unilaterally, and so buyers held back from the market to understand if the new price levels were sustainable. And we see here in March, as sales bounced back, that buyers understood that suppliers were not budging on their prices, and so the new higher level of the higher price levels were sort of took effect. So we are, and we've seen those sales continue to gain momentum through the second quarter. As far as inventory goes, the inventory tends to be fairly cyclical on RapNet, and in the market in general, that after the holiday season, the inventory diamonds have shifted to the retail market and out of the midstream, and so midstream inventory is slightly depleted. And then the cycle starts again with as manufacturing ramps up in the first and second quarter, and inventory rises again. But we are seeing a bit that inventory is a bit lower than last year. When we look at inventory, it's difficult to take a snapshot of the market without looking at it a little deeper. And we look at it, and so we look at it from a relative point of view, from looking at inventory relative to the amount of sales that are taking place. So when we look at the sales and the amount of inventory, we can understand if there are enough goods in the market to supply what the market is demanding. So our relative inventory calculation, I'd like to talk you through for a few minutes, gives us a indication whether there is enough stock available in the market in relation to what the market is demanding. So it's inventory as a proportion of sales turnover. So just as way of example, I'd like to take if we take and this is a page from this month's report, the July report, which will be published tomorrow. If we take the demand 1 carat sales and 1 carat inventory, sorry, 1 carat HVS2 diamonds that are highlighted. So we saw that 482 stones were sold in May, and that 990 stones were in inventory on RapNet or listed on RapNet of this category 1 carat HVS2 diamonds in the month. And so when we take those two numbers, we take our sales of 482 stones in May and divide it by 31 days, which gives us an indication that of this category, 16 diamonds were sold per day through RapNet in May. And at a rate of 16 stones per day, looking at our inventory of 990 diamonds, and if we divide 990 diamonds by 16 days, we get to the figure of 62 days, suggesting that there is enough inventory in the market to supply the market for the next 62 days. And so that inventory number, that relative inventory number, gives us an indication of really if there's enough stock in the market, and relative to previous periods. And so this graph plots the relative inventory in the market. The orange line shows that relative to last year, that inventory is in fact down, and that on a comparable scale, the market doesn't have enough, or has a relatively low amount of goods in terms of what the market needs. The bar graph, of course, is the sales per day that we have plotted earlier. And so again, as inventory is down, there are not enough goods in the market, and would support the higher prices that we've seen until now. The fourth factor that we're seeing an improvement is the time to sale of new inventory listed on RapNet. We see generally on a fairly consistent basis that about 70 to 80%, or 70 to 90%, in fact, of new inventory that's listed on RapNet is sold within the first 3 months, which is why I think an indication of it being such a powerful platform. But we're certainly seeing that the rate of new inventory turnover has increased in 2018. This is again this is total number of stones on RapNet, and we're seeing within the first month of being listed on RapNet, the number is edging towards 60% of new inventory, whereas a year ago it was close to 50% of those goods, and so we're seeing again that inventory is turning around at a much faster rate. So that's looking at RapNet on a total inventory basis. When we look at the 50 pointers D2H SI goods that we mentioned earlier, again this page is the snapshot page that will be published tomorrow in the report. We're seeing the breakdown of category of color categories a little different. We see that D2F, the inventory has increased quite substantially compared to the average of the previous 3 months, of the last 3 months, up 46%. We've seen that the average price is up 4.1%, and similarly on the G2H goods, and that prices are up around 3.5%, and inventory up 28%. This page gives us a great snapshot of what's happening in that category of diamonds. But when we look at that specific category of half carat D2H color SI clarity goods, we're seeing that the market was quite flat in 2017. In fact, it was on a fairly prolonged decline even before then. And then over the holiday season, over the holiday season from November, we've seen quite a sharp increase, and that has been sustained until May, with a slight correction more recently, but it's still up about 5% for the year. Again, we're seeing a similar pattern in terms of the inventory that's on the market, with the expected declines towards the end of last year and through the beginning of 2018, and then a steady increase in the second quarter. And again, the volume of sales has been fairly consistent, with a similar drop in February as prices rose in January, and and buyers held back because they weren't sure if those price points were going to be sustained. And as we've seen that those price points have been sustained, the buyers came back into the market, and there's been fairly consistent sales of this category good. When we look at relative inventory, it again tells that similar picture, that that the market needs more goods to supply the demand that's required of this category. And certainly compared to last year, the relative inventory is fairly down, which again supports our premise that the price, again the modest price increase in the second quarter and the first quarter before it is fairly sustainable moving forward. This graph plots the relative inventory against our price index, and we see that as our inventory has declined, the prices have increased, and again playing into that inventory, that there isn't enough stock of these goods, or that there is a steady amount of demand that's driving the market. And I like to think that it's a bit of both. Excuse me. And finally, the time to sale shows a similar pattern, that around 60% of new inventory of this category listed on RapNet is sold within the first month, and upward of over 80% is sold within the first 3 months. And so again, when we look at firstly on a broader term, on a broader basis of total inventory on RapNet, and also on the 50-pointers D2H SIs, we're seeing that prices increased. There are greater sales that are taking place through RapNet than last year. This time last year, we're seeing that that inventory is down, and that there are not enough goods to satisfy that improvement beyond 50 to 60 days, and that the rate of sales on RapNet has improved, which again supports our claim in terms of the macroeconomic and environment that's evolved, the more positive trading environment, and the changes that the industry is engaged in to ensure that it is more ready for the dynamic consumer environment that we're involved in. I will again premise that it's by no means a forecast that we're giving that the trend is going to continue, because there are challenges and there are factors that are out there that could derail that. But there is certainly reason for optimism in 2018 compared to the last number of years, which is something positive, and I think we should read the market in a cautious and correct way that's worth pointing out. So thank you very much for listening. Again, I'll be happy to take questions, both during the webinar and also via my email is avi.kravitz@diamonds.net. And of course, the report is available on a monthly basis. We're publishing late tomorrow afternoon, and we'll be happy to, if you want more information about that, the link is on the screen, and again you can contact me or any of our team to get more information about subscribing.